Now, between 65 and 85% of properties in central London were owned by nationalities other than the English between 2008 and 2013. In 2012, nearly 3/4 of new homes in London were bought by foreign buyers at around 16 rand per pound. Very few South Africans, including myself, can actually afford property in London, but that doesn't mean that the wide world isn't eager to have us. This week's cover story on Finweek takes a closer look at offshore property and property investment opportunities around the globe. Now, for more and a more in-depth look at, we're joined by Mark Jurgens, the CEO of Jurgens Finance, and Scott Picken, Senior Manager of Wealth Migrate and founder of IPS. Thank you so much, gentlemen and ladies, for making the time to join us. Now, let me start off with you, Scott. Why is it a good time right now for South Africans to even be considering offshore investments?
Look, I think the most important thing is that one actually has to decide. It's not just a case of where to invest. You can't just say offshore local. So if you say to me, is it a good time to invest in London right now? I don't think so. But there are other markets like the US where there's great opportunities. So it's very, you've got to get specific in terms of the different markets and where the opportunities lie.
So, Scott, if the complexities are not boiled down to an domestic or offshore option, what are the other factors that we should be considering? And maybe we can get some input on those things that should be taken into account as you consider where to throw your money.
Look, the most important thing with property is the fundamentals of property. They stood the test of time. I'm sure Mark will agree with me no matter what happens. So if you've got a market where you've got an oversupply, like in Ireland, like in Spain, like in Cyprus, and in the past in the US, you're going to have a problem later down the line. The second thing you've got to look at is whether the economy is in a good strength. So I mean, if you take London as an example at the moment, the challenge you've got with London is that it's an aging population. So it's going to have fundamental problems later down the line. The economy is in trouble. 70% of the economy is based, the GDP is based on banking and finance, which can move pretty quickly.
Right.
And thirdly, from a property perspective, it's the most overvalued it's ever been. The last 3 months, it's had the highest value ever. So strategically and systematically, it's at a far higher risk than other markets where you're buying at a discount and you've got a good income yield.
So let me throw it maybe to you, Jessica, to see if you can give us a little bit of insight here. Because if one looks at just the numbers and what people have to go through, and Londoners in particular, as they consider property, we're not only seeing a price, very high price, but we're also seeing other structural impediments or barriers to actually being a homeowner. For example, the amount of deposits that they have to put down. So as a South African, in addition to that, what other structural impediments are you having to take on?
I think you could probably speak better on this than me, but I think tax and the transferal fees and that kind of thing are very complicated for a South African to have to face, especially sitting here. And I don't know how much advice South Africans really get on the ground when they're facing those questions.
Well, I know a lot of South African investors who have bought property in London, and one of the surprises, put it that way, a lot of people have found that there are a lot of unforeseen expenses and expenses they weren't aware of. Things like ground rent. Things like paying for the levies, which are slightly different to our levy structure that we have here in South Africa. The high cost of paying a management letting company to manage the tenant for you and look after the maintenance of your unit as well. I think if you take all of these costs into account, you can be taking close to 20% of your rental income away in that vicinity. So it does become fairly expensive. As Scott said, I think the London property is pretty expensive at this stage. He'll tell you there are better opportunities in the US.
Right.
But there are barriers there, and there are things that you have to do a lot of investigation.
And surely people complain about being renting here and how challenging it is and how to get tenants out. And it's very difficult just managing an apartment in Lone Hill when you're sitting in Sandton. So to handle something in London when you're sitting in Joburg must be extremely difficult.
I think it is very difficult, but there are some companies, and I believe there's some South African people who've set up companies in the UK now that look after those, all of those issues for you. They take care of new tenants, they take care of the lease, they take care of if you have a dripping tap or you need any maintenance done in your unit, they'll do that.
But I would presume at quite a high cost.
About an average of about 10% of your rental income, so it's fairly pricey.
Yeah.
Can I answer that for you? I think it's very important. There's actually a stat that came out in 2010 that over 80% of South Africans that invest overseas lose money. Now, the interesting thing, exactly what Mark said, they go on a holiday for 3 days, they fly all the way to London, they say, I'm going to buy a property. They walk the streets, the estate agent tells them exactly what they want to hear, and they buy it. Okay, now with all due respect, if an Englishman came to Joburg, what would be the chance of finding a good deal within 3 days? It's impossible.
Yeah.
They also, we believe that buying the property is 20%, managing and maintaining the property is 80%, which is exactly what Mark is saying. But if you're a sophisticated investor, Trust me, if you own a property in Lone Hill, you're not managing it yourself either. You know how to find the right management agents, you know how to find the right type of partners. Property is all about information and partners. You've got to have the right information and the right partners. And so whether it's Lone Hill, whether it's London, Sydney or New York, it's irrelevant. You've got to know how to find the right partners.
Okay. Can I just ask a question in terms of investment in property? Okay, so the Social Housing Foundation found that 12% of your rental income should go towards maintenance of your property. If you take that into account, and you also take into account that you're paying someone to actually manage your property for you, isn't it actually better to just invest in a property fund as opposed to a physical property? If you look at something like the Marriott, I think that's what we had, the Marriott Property Fund that has quite a big exposure in the US market and 8 other markets. I mean, isn't that a much better option?
Well, I'd say yes, and I would say particularly for the smaller investor, because if we look at funds, certain property, global property funds, unit trusts in South Africa, they've given returns in the last year of 15-16% in dollars. We've had over the last 12 months the rand appreciating significantly as well.
Right.
So if you add that, people have returned approximately a 30% return. But what's the reason for you investing in property? Do you eventually plan to go and live in the UK? Do you want to go and live in America? Do you want to live in Sydney? Political instability here is another consideration that one looks at when investing in property. But I would argue that a lot of the unit trusts, it's easier to invest. You can invest with amounts of money of 10,000 rand upwards just to get exposure to that particular sector.
But to a large extent, I think we've dwelled a lot on, just what not to do, and definitely it sounds like it's not a good thing to go into the UK property market right now. But then where should you be considering? And also to bring in the African context, which hasn't received a lot of visibility right now in terms of a prospective asset class to invest in. So where should you be directing your funds?
Well, I think the unit trust portfolio managers will make those decisions for you. They're professional people and they do research into the best areas to invest. They've had good returns in the last year because a lot of that money's been exposed to the retail sector. And remember, they're buying and selling equities. Those funds are yielding 4 to 4.5% return in dollars. And there's been good capital growth over the last few years. The international property sector is still not where it was pre-2007 crash. We've still got some way to get to where we were just before the crash. So they'll make those decisions for you. Scott will tell you there are good opportunities of investing in the US at the moment, and perhaps that's something else to look at. But it's because it was so distressed, and it has been over the last couple of years. We know that they've turned the corner, and property prices are starting to increase in the US, and that's perhaps a far more attractive area to look at this stage.
I think there's two things to add to what Mark's saying. Firstly, any investor, the biggest lesson I learned from the global financial crisis is any investor that goes after capital growth, it's like betting against winter. It will come and you will die. I guarantee it. Okay. If you focus on income, you not only survive in these times, but you thrive. So in terms of net yields of 4.5%, we're netting in the US at the moment between 8 and 13% in terms of direct property. If we go into the bigger properties, so anything below $1 million is what we call a mom and pop environment. Everything we're buying between $1 million and $10 million, we're netting between 12 and 20% in terms of direct property investment. And the most important thing I believe there is that our interests are aligned. There's not cream being taken off the top in the middle, in the beginning, the middle, and the end. We are investors ourselves. We're investing with sophisticated, like-minded investors that want passive investments, and then we can take advantage of the market. So it's different strokes for different folks. But I think, as Mark said, most importantly, and what you guys have done in your magazine, you've got to get the knowledge first. You've got to understand the intricacies of what you're actually doing, and that is vital.
And Scott, just to bring Africa back into the conversation, there are emerging opportunities there, but obviously Africa isn't just one big chunk. There are different countries which have different opportunities. Could you maybe give us some more insight on where people should be looking? I believe you've just written a book on this with Clem Center. So share your insights on that.
Look, just to give you a little bit of feedback on that, Clem Center, if anyone's been to any of his talks, has 4 different scenarios for the global economy. Then he has 3 different scenarios for the South African economy, which encompasses Africa as well. What we did is we built a 4-dimensional model where we took his theory and we gave people a system, a formula called the GPS system, the global property system, to be able to choose where to invest. So if you take Africa as an example, the fundamentals, some of the fundamentals are right. Population growth is on the up. There's a need for housing. But some of the fundamentals are not there. There's no laws. There's nothing to protect you with regards to putting a tenant in. So just like India, the fundamentals can be right in one place in terms of population growth, supply and demand, and even in some instances the economy is growing at 7 or 8%. But then the rule of law is a fundamental. It's like 4 legs of a table, and if you don't have one leg, the whole table falls over. And that's what the GPS system helps you do, because you've got to have all 4 fundamentals, and it helps you choose where the best place is to invest. My one thing I would say with Africa is that There's good opportunities in Africa. The problem is there's no financing. So it's a very capital intensive investment which is going to implicate your IRR. And when you can get 50% discounts of replacement value in America at the moment, 8 to 13% net yields, for me, I don't understand the point of taking that risk and investing in Ghana or Kenya or Zambia.
I would agree with that. Too much political risk at the moment, still investing in Africa in your individual capacity. But I think there are some funds. Some of the portfolio managers have told me that they're going to be launching some African property funds within the next year or so. But these won't be investing in residential areas. Obviously, they'll be investing mainly in retail once again. And they expect competitive returns from that. But a lot of work and a lot of effort goes into monitoring the stability and the reputedness of the organization that you actually want to invest in.
And I think it's the quality of your partners. If you've got the right partners on the ground, they're going to get you the returns.
That's right.
Shed some light for me. I mean, of course, we're all uncertain about the effects of quantitative easing and how that's going to spill over into interest rates. Where do you see this going, and how is it going to impact on making that particular investment?
Well, that's the risk we face with property going forward. A rising interest rate environment, will affect property prices going forward. We saw what happened recently with Mr. Bernanke making his suggestion of the tapering off. That's the risk that we face with property going forward. It seems to concern certain portfolio managers more than others. But I think over the longer term, when you look at investing in a property, and particularly maybe investing in a residential property anywhere, it's a 5 to 10 year investment at least. You wouldn't look at a shorter period of time.
I also think, to be honest, guys, you can get analysis paralysis. You can look at these macro things and what's the impact going to be. And we're buying a building in North Dakota at the moment, which is where they found oil. America's going to be self-sustainable in oil by 2017. 1,300 businesses have come into Watford in the last 2 years. There's not 1 square meter of office space. We've got the building pre-let 80% before we even go into the ground. I don't really care what happens with quantitative easing in terms of the investment,
Right.
And in terms of South Africans and their approach and their attitude towards investing offshore, how are we risk averse? Are we sort of eager to go into new markets? What have you found?
I think most people, first of all, you find people that have got people that are reasonably high income earners. The amount of people that have money offshore, the percentage in South Africa is very low. So our job as advisors is suggesting to people that they get more offshore exposure. We were less than 1% of the world's economy in South Africa. There are plenty of opportunities to invest offshore, but the majority of people don't have that because they feel safe and secure with their money in Africa. If we go to conferences overseas and people chat to me and they say, do you look after do your clients have most of their money in Africa? And I say, yes. They look at me as though they think I'm crazy.
Yeah.
They don't realize. They look at it and they look at a lot of instability and they look at a lot of risk anywhere in Africa. So what we're saying is people should have at least 30% of their assets invested offshore in a selection of property and equities and various investments.
And as with any investment, it's a long-term game.
It's a long-term investment, very much so.
But I also think there's 2 things, and I'm a Durban boy, so I'm going to apologize up front. But that whole saying, "a fair van jou goed na in jou skade," if it's a long way away from your heart, you're going to lose it. Those
is that
days.
a Durban boy speaking of? We can't.
Yeah, I'm trying my best. I'm trying my best. But to be honest, those days are gone. That's 20th century. If you're not thinking globally, if you're not chasing the globe for the best returns, you're in the 20th century. It's very simple. And considering the rand has lost 26% from the 1st of January, and it's actually more now, considering what's happened the last couple of days. I'm sorry, but the blatant truth is, if you've got all your assets in rand, you're 26% poorer.
Okay, so explain to me, if I am, as an individual, I'm investing, putting money away, what percentage of that money should go into offshore property, and what percentage should go into offshore like equity, that's not in property?
Scott would probably say a bit more property than I would, but I would say perhaps a little bit less than half in property is what I would say. That's why people build up lump sums by investing offshore in hard currency and building up money. And maybe you could use that in 5 or 10 years' time to put a healthy deposit down on a physical property if you wanted. But there are the unit trusts that invest in, they make the decisions for you. Some of them will be more aggressive on property, some will be less. But I would generally say 30 to 40% of your money in property funds, and maybe the difference in equity-based funds.
And that's just the money I invest in money or in investments offshore.
Well, I mean,
not 30 or 40% of my total.
That's an offshore, because I think properties in certain areas, as Scott said, is showing good valuations and good opportunities now. It hasn't always been the case, but there are some good opportunities, and it's to identify those and put those in the portfolio, but have an exposure of equities as well, because there are lots of companies that are going to perform well in the next year as well. So you want exposure and you want diversification.
I think, I was on a presentation last night. Clem and I were presenting on the launch of this book,
Right.
Property Going Global, and where it's happening. And Clem actually said, he would put a third into equities, a third into property, and keep a third in cash. And that's what his dad's done, and funny enough, that's what Warren Buffett recommends. And then someone said the whole offshore local, and he said, well, I would probably do the same thing in terms of a third, a third, a third, so that you're not got all your eggs in one basket. And I always say to people think it's a South African thing, almost a traitor to invest overseas. If you had all your money tied up in American property in 2007, you'd be feeling like the class clown right now.
Right. Before we quickly close, I think to a large extent we've looked at the dichotomy about Africa and the rest of the world, and we haven't really touched on South America in particular, which receives quite a bit of coverage. If you had to give me just quick insights about what the offshore investment opportunities look like in that part of the world.
Look, from my perspective, Brazil's a very interesting one. I think I'll need to go, and it takes me about a year to understand a market before I go. So I'll definitely need to go in the middle of next year for about a month to check out Brazil.
Around the World Cup.
Around the World Cup, exactly. But the interesting facts there's 100 million people that have joined the middle class. And just like we saw in South Africa, when you've got a burgeoning middle class, the fundamentals are right. It definitely needs more investigation, but I think it's a great opportunity.
A quick one from me.
I think your opportunities there as well in countries like Chile and Santiago. I believe there are very good opportunities there. Perhaps not in Argentina at present. So as Scott said, you'd have to do a lot of research and work if you wanted to actually go and invest in property there. Either deal with a reputable portfolio manager who's got a lot of experience in South America, or go and do research there yourself.
But I think one last thing very quickly. South Africa is an emerging economy. There's great opportunities here. Don't necessarily jump out of the kettle into the fire and go into another emerging market. For my philosophy, when you take your money out, look at a first world country where you're getting first world assets, first world income, and first world returns.